Thanks, Steve. Last panel before lunch, so hopefully we can keep everybody awake. So I'm here joined today by Marco della Giacoma from the portfolio manager at Tenax Capital, Mike Rich, who is head of ILS at K2 Advisors, Hervé Castella, who is chief third-party capital officer at SCOR, and then to my right here, Florian Steiger, who is the head of cat bonds at 12 Capital. So hopefully interesting combination here between ILS managers and also the sponsor perspective, where we really, as Steve said, want to talk a little bit more about the outlook on the cat bond market, and then also touch upon private ILS as well. The first topic we want to kind of maybe touch upon, and I know there was kind of a prior panel earlier today about the investor sentiment, which really, I know Lorenzo touched upon from a consultant's perspective and from an investor perspective as well. But given that we have here a number of the ILS managers, I wanted to kind of ask each of the panelists here a question around what they're hearing from investors, what their on-the-ground experience is in respect of sentiment. Obviously, end of last year was a very difficult period, which has shifted quite materially where we are today. But maybe starting, Marco, from your perspective, what you're seeing out there and what your discussions you're having.
Sure. Well, what I've seen is that the interest is very selective, as was also said by the previous panel. We got some kind of prospective investors that when they saw situations like Ian last year and see that the market, or this market, can post like 9–10%, even if it's just a mark-to-market loss within a week, got even more scared off by ILS and probably went back like to zero in terms of our education journey. Whilst the more educated investors, or the one already in the space, obviously saw the opportunity of coming back in with higher spread, higher yield, but that already was happening well before Ian, so like from Q1, Q2 last year. So I think what happened last year in terms of the event, Hurricane Ian just made this kind of differentiation and feedback that we got from existing and prospective investors. On another note, I think that the rest of financial markets have given us a big hand, in the sense that condensed in the space of a few months, we had situations like the U.S. regional banks kind of falling one after the other. We had FINMA ruling that the Credit Suisse 81s were actually junior to equity, which is surprising to say the least. So ILS suddenly became even more a beautiful place to hide from this kind of volatile or surprising events affecting the rest of financial markets, inflation, central banks, hiking rates. So if it was a beautiful place to hide when spreads were in the 300 to 500 basis points, imagine now that we are now close to double digit. So I think to summarize, investors not yet in the space probably need one more round now of education to get back the confidence after what they saw, whilst investors already in the space see the opportunity and are looking to reload or get back in the market.
Thanks. Mike, do you want to?
Yeah, and echoing similar sentiment there, in the sense that across the ILS space, we've seen, I'd say, more interest tilting towards the cat bond end of the spectrum, especially after the last several years on the private side. Just the growing frustration for maybe some of those investors who first went in 2018 after that heavy event year, where everyone was waiting for the events to pile in. And if you invested in 2018, that 5-year period up until the beginning of this year was not exactly the best. So it was a challenge to continue to get comfortable with those private markets, especially with the trapped collateral and side pocketing. And it's became more and more difficult for ILS investors and allocators to go back to their investment committees and say, hey, look, this is a very, very attractive opportunity. We're seeing a strong rate reset going into the start of 2023, and it was probably similar conversations in the prior few years. So it was a tough hill to climb, at least with respect to the private side. On the cat bond side, we've seen obviously a pretty heavy investor inflow activity there. Having the access to the secondary market to have some level of liquidity throughout the year was definitely looked upon favorably, and given where spreads have gone with the collateral return, you're seeing finally the spread is filtering down into actual returns for the funds and the managers, and that was something we'd been hearing in the prior years from potential investors saying, hey, look, we understand where the spread is, we understand it's uncorrelated and diversified, but at some point we're going to need that spread to play out and actually generate the returns. And given the event activity that occurred over the last several years, there was just that difference between what the forward-looking spread guidance was and the actual returns, which also served to turn some people off to the asset class. So fingers crossed we can get a clean year for the rest of the year. And going forward, I think that could bring a lot of potentially new investors into the space who were waiting and looking for a year of relatively minimal event activity, particularly for peak perils.
Thanks, Mike. Maybe before jumping to the sponsor perspective, I don't know, Florian, if you want to give maybe your perspective as well.
Yeah, sure. Maybe one additional comment, and I think you're exactly right when you distinguish between private ILS and cat bonds. But even within the cat bond space, it's not all shiny. So yes, we've seen a lot of appetite. We've seen a lot of investors coming to the cat bond space at the first time. But I think the topic here is sustaining returns and driving growth. And maybe both of them are not achievable at the same point in time. Because we've been saying to clients, now is the best time to invest. Yields are at multi-year highs, which was always true. And then they always went higher. And then there was Ian. So people kept asking, okay, so you promised me a good return. Where is it? Now for the first time we can say, here it is. I think we had a wonderful 2023 thus far. But if we now get into a period again that more and more people are jumping onto the cat bond train and spreads are driven much lower, a lot of these investors, they are not yet in for long term. They came in the past 2 years. They might leave the space again. So I think it's important for all these investors actually to be converted from tactical investors to true strategic buyers of the asset class, that indeed we are able to sustain returns. And I think that's a challenge for the entire industry, and I hope that we can manage to do that.
Yeah, and I think it's an interesting question too. I know we talked about cat bonds and private ILS, and we're going to spend a little bit more time later in the panel talking about the property cat market and where there's maybe pockets of growth as well. There's obviously interest in shorter tail lines, interest in also appetite in others. I know cyber and other topics have been covered, but even longer tail lines as well. I mean, Hervé, maybe from a sponsor perspective, you can talk a little bit about that as well.
Yeah, so we're issuing a private ILS transaction, both in cat and non-cat. And I would say after 2022, which was very difficult, I think in the first half of 2023, we saw renewed interest. And I would characterize it between types of investors. So on the asset manager side, the more tactical allocator, we've seen interest on one hand for property cat because of the hardest market we've seen in 20 years. But we also seen the one that basically look at an asset play, basically long tail lines where there's some reserves accumulating and asset leverage to complement, enhance the underwriting return by investment income. And then you have the pension fund, more the strategic allocator, which in private ILS have been still very, very cautious because of basically the experience, the performance. What we've seen is some interest for more diversified portfolio, less exposed to volatile property cat, but it's a long process. I think it needs education, but it provides a little bit of operational leverage as well for investors in terms of, for each dollar invested, the premium ceded is larger. So it gives really attractive returns, but the process is longer, so it will take time until it picks up.
Yeah, and I think it's interesting. I mean, certainly the comfort level obviously started in property cat, and that's really where we see the biggest spread, including obviously the growing kind of cat bond market. Maybe diving a little bit into that market segment, and again, Florian, to your question on kind of, we have seen some growth in capital. We obviously want to also see continued growth from a sponsor perspective, and how the pie can kind of grow. So bringing new risks like cyber and other things, but even within the property cat market, there's a continued demand also from some of our clients to bring in more robust protection, including also things like secondary perils and aggregates and other types of transactions. And obviously that is always worth the links to discussion from a risk assessment type perspective, and I think more importantly even from a structural type perspective. I think from a manager side it would be interesting to hear a little bit your views on do you see that as an area of growth, or it obviously needs to be structured in a mindful way and assessed in a mindful way? But I know, Mike, if you want to maybe start, and Mark, I will jump in as well.
Yeah, I think in terms of growth, we're always looking for new sponsors to come, particularly on the cat bond side. There's always been those core cat bond sponsors who come to the market multiple times a year. I think what may happen going forward is going to be the sponsors seeing where the capital is and where they're going to be able to best transfer that risk. And as of right now, based on what we're seeing, there's more of that capacity available on the cat bond side versus the privates. Not to say that can't change in the future depending on how the market shapes up. And then within the cat bond market, obviously we'd like to see some more diversification across geographies, with the caveat that understanding the modeling may not be as robust as for those peak US perils. And in terms of just aggregate exposure, it's been a challenge to get comfortable with those types of bonds, just given the elevated frequency over the last several years. We have seen some sponsors look to make some structural changes to try to mitigate some of that impact, whether it's increasing a franchise deductible or adding an event deductible or a max event cap per event. So we're seeing the sponsors work to try to figure out a way to make these aggregate deals more palatable. But when you have months like June of this year, even with all of these structural changes, there's still pretty significant loss and aggregate erosion for these deals. So it's a bit of a challenge, but we're encouraged by the sponsors looking and understanding where the challenges are and trying to resolve and mitigate as best they can.
Yeah, and if I can follow up on this secondary perils theme, which I think is very relevant. I think for some investors and for managers as well, sometimes it's more like an on-off situation, in the sense that if I've got a deal that covers peak and non-peaks, like basically wrap everything, and I don't feel comfortable with the secondary perils exposure, sometimes that means not investing at all in the deal, so reducing the amount of capacity that someone can provide to the market. So as Mike said, a lot has been done from the sponsor perspective to make investors more comfortable with this kind of exposure. I think more can be done, and perhaps like kind of a provocative, say, proposal to structures is why not considering sometimes maybe for larger programs, to kind of split the coverage between classes. So you still have your all natural peril deals, but then you do like class A, where you put in your named perils exposure, and then class B you put everything else. I think it may be that like that you have an aggregate amount of capacity which is larger than the single class, and from a pricing perspective it can also be that the sponsor would achieve on an aggregate basis maybe a more efficient pricing levels. For us, right, that would mean, for instance, being able to provide capacity for the perils we like without having to say no to the deal at all. Because, I mean, we get this question from investors the last few years, like, we see losses coming not from the hurricanes, but from, hail, tornadoes, and severe convective storms. We didn't think that was the cat bond market. So, we have to go back, try to speak to them, educate them that, yes, maybe we talk about peak perils, but in the end, what has driven losses in the last few years has been non-peak perils, back from the wildfires in 2017 up to what happened in spring this year.
Florian, do you want to share maybe your perspective?
Yeah, I think you said most of what I believe is true. Secondary perils are certainly an area of concern, I would say, and it's just very easy for an investor to look at the statistics, to see that now we've had, I believe, 15 events in the convective storm space this year, bigger than 1 billion of insured loss. And then you look at the modeling, and it's a different world. It doesn't match anymore. And then clients start asking good questions. They ask, hey, Florian, 10% spread, that's nice. But are you sure the risk is truly 2%? Maybe it's 6, maybe it's 5, we don't know. And I think it's for us to give answers which are better than what we can give today. Because it's hard to believe that the models tell you winter storm, let's say 5 billion, happens every couple of 100 years, and we keep getting it every year now, it seems. Well, there certainly is an element of luck or bad luck involved in this, but I think if we were to do a quick poll here, who believes that the numbers are too conservative, I wouldn't expect too many hands up in the air. And I think that's an area of concern which need to be addressed by the modeling companies. Maybe we need to do the modeling updates more frequently, a bit more proactively, but otherwise we risk losing the patience of investors again. And we spent years of building the confidence for people to finally now invest into the space. If you now get 2 years of losses from non-peak perils, that will quickly evaporate again, and those people probably wouldn't be back for the next 10 to 15 years.
And there are certainly kind of two elements, or the quantification side, and then also I mean, I think, Mike, you mentioned that, or the structural side as well, with to provide certain mitigants. I mean, Hervé, maybe you obviously have a little bit of a perspective into the traditional reinsurance market as well. Yeah.
So, as Burkett Keys said this morning, it was all about terms and conditions. So I think there was a push initially in the renewals for named perils. Typically, they would include a long list of known perils. At the end of the day, I think it got traction only for upper layers or very large program where capacity was needed. And for the rest of the traditional market, it was not really taken up. However, I think most importantly is really event definitions, hours clause. It's around seed and retention, which has an impact, a huge impact on secondary perils. I think we've seen it, you know, with the Oakland flood, with the they almost don't touch any reinsurance layer anymore. While 2 years ago, basically retention had been much lower. So I think that's more these factor that makes the property cat reinsurance portfolio now much more robust than they were. It's not only rate, it's really these terms and conditions.
Yeah, absolutely. Okay. No, I think that's helpful. Maybe shifting gears a little bit, again, coming back to the cat bond market in particular, obviously the transparency and liquidity are big arguments when you're speaking to investors. A decent portion of the market is also provided specifically or by UCITS funds and mutual funds. I don't know. So some of you guys are kind of very close to that as well. Would be good to talk a little bit about from a UCITS perspective in particular the recent regulatory commentary which was made public. What's kind of the investor feedback? What are the concerns from your side and thoughts around that?
Yeah, look, I mean, we run a UCITS fund investing into cat bonds only, and to be honest, and to be very brief here as well, I don't think that there should be a concern over liquidity, safekeeping of assets, and availability of valuations for the cat bonds. So the ESMA surely is doing a good job in trying to protect investors and retail especially. You don't want to have someone sitting on a risk they don't understand, or it's illiquid or it's wrong valuation. At the same time, though, you have like a random guy from his phone can buy a short inverse leverage ETF on whatever asset class. So, you know, the two things don't really match, in my opinion. You have 81s that are only for qualified investors, but retail clients can buy 81 ETFs. So at the end of the day, the risk is the same, despite obviously a broader diversification. So I think the ESMA is correct trying to look into this topic, but at the end of the process, I expect the cat bond market to gain strength in the sense that it is, say, feasible and fit for a UCITS fund and for all the rules and the criteria that regulate the UCITS fund. So I don't think putting ILS and cat bonds in the same bucket as if it was crypto, private and liquid assets work. I think at the end, the result would be, yes, cat bond, big time can be included in UCITS funds. And if that's not the case, then I expect a lot of more asset classes that will face issues.
And do you see any difference between kind of the jurisdictions, or is that?
No, I haven't. I think the question is always people don't understand that cat bonds, if you want daily liquidity, you don't invest in cat bonds to the same extent. If you want weekly liquidity, you don't invest in private equity, right? So there is obviously a situation here. But when they argue, say, against safekeeping of asset and especially availability of valuations, we've got multiple sources that provide indicative prices of cat bonds every week, every month. We've got a liquid market. It's a small market, but liquid. You saw situations like COVID in 2020 or the war early last year, where the cat bond markets were probably among the best liquid market out there. Like, I was trying to sell some corporate high yield bonds in February 2020. It's basically worse than trying to sell a Florida bond when hurricane is passing through Miami. So liquidity, is bad whenever the asset class is under a bad scenario. But cat bond do not have anything, I would say, less than corporate high yield when that market is in distress.
Okay. Yeah, let's talk about the liquidity maybe in a second, just maybe kind of on the usage point.
Yeah. Well, managing a fund, a usage fund, which is close to 3 billion, I'm concerned by the approach that the regulator has taken here. And they are looking into two things. They are looking into harmonization of rules across Europe, which is not the case right now. So in Luxembourg, you have different rules in running a usage fund than you have in Ireland, for example. So that's one topic of concern. And the other topic of concern is what you point out is usage eligibility from a liquidity perspective, from a valuation perspective. And I get why the regulator is not happy with the asset class. Otherwise, it wouldn't have landed on the list of crypto, unlisted equity, and carbon emission rights. Because let's say you want to look up a cat bond on Bloomberg. You put in the ISIN, and then up comes the Bloomberg page with some cryptic information. You get 0 broker quotes. You get 0 valuation information. So what does somebody who does it in Brussels think of the asset class, of that bond? They think it's illiquid. They think there's no valuation price on Bloomberg. And a lot of these concerns could be overcome by better transparency. For example, we all get these broker valuation sheets every Friday or every second Friday. Why not make them public on Bloomberg, that if somebody goes onto Bloomberg, puts in the ISIN, goes into all quotes, you get all the quotes from Swiss Re, Aon, from you guys. It would be an easy fix. And I'm afraid that unless we get this right as an industry, unless we provide that level of transparency, unless we give the ESMA the comfort that there is some liquidity in the market, and it certainly is not as high as in the high yield space, but it should still be good enough to run in usage funds. But there's a lot of work to be done, and I think the work that needs to be done should be started right now, because otherwise the ESMA might create the very liquidity event that they would be afraid of. Because what happens if they decide 10 billion of usage fund in cat bond space? It's not eligible anymore. I guess there will be a grandfathering period, but I can imagine there might be quite some selling going on. Create buyer's market eventually, but I don't think that can be the goal of the regulator. So let's hope this goes in an orderly fashion, and we as an industry are able to actually provide the help to assist in that technical assessment of the cat bond market.
And maybe just coming back to a little bit to the prior question around investor sentiment. I mean, what's kind of your outlook specifically in the usage space from a?
Yeah, it's fine, because if I think of our investor base at 12 Capital, none of those people are retail investors. Nobody needs UCITS. It just happened to be that there is a race that you want to be in UCITS cat bond fund because it gives you the highest level of protection. And that's maybe also a bit strange, because why is the ESMA looking into the topic? Because they think UCITS is for retail. But then you look at the cat bond investor case, and there are hardly any direct retail investment in the cat bond space. And so from that perspective, it doesn't concern me a lot from an investor perspective. Most of them would just switch into an AAF or into RIFE or any other structure. But it would certainly not be helpful for the market to develop. And maybe one comment on the side, and that's quite strange, because at the same time where the ESMA is, I would say, trying to shake up the market, the ECB is putting out a study how great cat bonds are to manage climate change and how much more of a common tool it should be to mitigate those threats. So I would just hope that they exchange notes at some point and come up with a more common understanding.
Marco, just from an investor sentiment perspective?
No, I mean, I agree. Usage as well for us is just for institutional, so we don't really see the reaction of retail investors. But as I said, I just think at the end of this, nothing will change for the usage landscape within cat bonds.
Yeah. Okay. And then, Mike, maybe from your perspective, also from a US perspective, there's obviously the...
Yeah, I think in terms of transparency with the quotes would definitely be a welcome change. Additionally, on Bloomberg, with the reporting of the secondary trades, the US broker-dealers, they're required to post trades on Bloomberg. European brokers, not so much. So I think harmonizing those to see just the actual trading that is happening when it does happen. And in terms of liquidity, I'd be remiss if I didn't point out, as mentioned during COVID, or the outset of COVID in March of 20, when the traditional asset classes on the credit side were really tight from a liquidity perspective, with the traditional credit and structured credit and MBS markets having to make margin calls. And where did they turn to raise liquidity for some of these multi-strategy funds? They turned to the cat bond market to raise cash, because they knew there would be active bids there. And I believe the number was over $1 billion of notional cat bonds trading on the secondary market when there was that severe liquidity crunch across other traditional asset classes. So to show the value and the actual liquidity that is there in times of stress, I think is an important factor in part of all of this discussion.
And then maybe coming back to the liquidity and the importance, not only in the UCITS context, but general, I mean, maybe Florian, from your perspective as well, I mean, the secondary trading element, how much time are you guys spending on that? How important is that for the franchise? Is that more rebalancing effort, or?
It's more rebalancing, so typically we try to rely on the primary market, but given that the fund has grown so much over the past 5 years, we did much more secondary market than we would like to do, simply because we had inflows and we were able to deploy in secondary markets. So I echo your comments. I think the secondary market is much deeper than people give it credit for. But again, how would they know? It's not visible.
Yeah. And Marco, from your perspective?
Well, for us, we have a smaller fund, so we do most on primary, and we use secondary only on opportunistic basis, like in a post-event scenario, for instance, or where we see like selling pressures in the rest of the market. So we haven't really changed our approach to that in the last few years based on what happened in the market.
Yeah, okay. And then Hervé, from a sponsor perspective, obviously liquidity of your deal is less important behind the scenes, but from a value of the liquidity, there's obviously price points and others. Is that valuable to you? Is that less valuable because obviously the investor base is changing, or is that a feature?
I must say we're not close enough from the actual trading of the bonds. Or I mean, we mainly as a sponsor involved when we raise the primary issuance. I would have less comments on liquidity from our perspective.
Yeah, okay. I think that's helpful. Maybe talking a little bit more about the sponsor perspective, and again, coming back to the topic of growth and driving growth. Can you share a little bit your thoughts on what the market could be doing to either grow the pie or to grow the participation?
I think we need to look at where there's demand for capacity in the insurance industry in general. Yeah. So I would say clearly in the short or medium term, clearly private ILS in property cat, there's a shortage of capacity. And I'm not talking cat bond, I'm more talking about private ILS, and frankly an environment which is I've never seen in my 20 years career in property cat, so quite attractive. In the medium to long term, I would like to come back a little bit on the cyber from a sponsor perspective. Not that we currently issue a cyber cat bond, but I think there would be quite a lot of interest from reinsurers like us. I think if I look at insurance, we can get reinsurance on our insurance portfolio relatively easy at the moment. Over time, it will grow and will be limited. But on the reinsurance side, I think the retro market almost doesn't exist. And when we look at cyber as a risk, we use all this model to manage our capacity. So we're looking at capacity that basically reflects our PML, and there's not enough basis risk. We're not there yet. I think evaluating the basis risk as a sponsor for cyber is very, very difficult. The only thing we know is if someone wants to offer us just cloud outage and it's not driving our PML, it's not really of interest. But I think over time, Cyber is certainly, it's a systemic risk where nobody will have the capacity to keep it in the traditional market. And I think on the other non-cat lines, I think there is some potential for growth as well.
And on these other non-cat lines, are there any in particular you feel could have good application?
I think clearly the casualty has a lot of issues. I mean, we've heard it this morning as well. But clearly with the inflation environment, driving reserves, there's a shortage. There will be an increased shortage of capacity, especially in the US for casualty. And there will be a need, maybe through LPT or through other private ILS transaction to basically offload some of these risks. So there I see a potential, and potentially a closer match with investor sentiment for those investors that I mentioned before, who are looking for as well an asset play.
Yeah, I think the key question will be what structural form that risk transfer takes. And yeah, I mean, I think maybe turning it back to the ILS managers, or you obviously having a lot of discussions with investors and their opinion around and comfort level. I don't know, Florian, if you want to share a little bit your thoughts on that.
Yeah, I think it goes back to what was discussed extensively on the first panel. What does an investor want? And in the end, they want diversification. And it leads to the question that I need to ask myself as portfolio manager, why should I try to diversify within the diversifier? The clients themselves can diversify much better than I can. I can only buy cat bonds. They can buy corporate bonds, commodities, real estate. And to that extent, diversification for us is only interesting if it comes at the right price tag. And a lot of the diversifying cat bonds, and I guess it would be similar for these topics eventually, in the industry environment where we are in, where you can earn 5% on the T-bill, why bother buying the diversifier at 7%? Just keep it in cash. I mean, there's no point in it really, unless we see a much better pricing, at least in the cat bond space. It might be different if you use fronting. They have certain requirements on what your tail risk can look like. But for a fully funded ILS investment, I think diversification is only interesting within the diversifier if it comes at the right price. Otherwise, we have to be honest and people tell them, look, instead of giving us 3%, give us 2% of your asset allocation and put the money elsewhere. And I think that's the only honest answer we can give.
Yeah, I think, I mean, that comes back a little bit to the question of instruments, cat bonds, private ILS, other structures, as Hervé mentioned. I mean, when you talk to your investors, like the element of liquidity we touched upon, the price, the discovery, and so forth, what kind of ranks, like, most importantly from their perspective, is that those elements, or is it really more risk-adjusted returns or otherwise? Or it depends on the investor.
It depends on the investor, it truly does. But in the end, it is the risk-adjusted return and the fact that you can get it in a semi-liquid format. How we get there, they don't care too much.
And Mike, maybe...
Yeah, I definitely agree with that, the risk-adjusted return with that liquid component. It's a challenge for investors to take that extra illiquidity if maybe in a normal year you're looking at getting maybe 2 to 3 to 4% on top of what you can potentially earn in the cat bond market with maybe similar risk profiles. So that's been a bit of a challenge recently, and maybe the last couple of years, is how much return are you willing to, or how much return do you need to be comfortable taking that illiquidity, understanding that you may not be as diversified within ILS in the cat bond space as you may be able to get on the private side.
Yeah, just I mean, I couldn't agree more. Just to add a couple of things, it really depends on the investors in the sense that if I think about the most conservative side of my investor spectrum, what they care the most is the diversification benefit that ILS as an asset class provide them on their overall portfolio. So for them, if spreads go much higher, much lower, it's not a big deal in the sense that what they care the most is again this diversification power. Then we've got some other kind of investors which are more maybe total return or absolute return focused, and there is in fact a threshold where if pricing of cat bonds goes below a certain amount of spread relative to other asset classes like high yield, for instance, then cat bonds become less attractive, and so they are willing to go in and out more frequently depending on the spread level that the cat bond market can offer. I mean, one more thing on diversification, which I think it's a long-standing topic. I think in general, an investor would expect that within an asset class, you offer diversification almost by default. I also think, though, and this is something which is coming more and more lately, some multi-asset managers investors are realizing that the power of diversification of ILS doesn't necessarily come if you diversify also within ILS, as Florian was saying. So as long as we can provide them the diversification level they want, we can, and we've been asked actually to reduce the level of diversification within the ILS component, so trying to, ignoring, say, some of the very, very tight diversifying perils around.
Yeah. And then maybe on that topic, it would be interesting to hear in respect of risk. I mean, we talked about risk-adjusted returns, and obviously, to your point, the interest rate environment has shifted materially. It would be interesting to hear kind of from each of you, how has the expectation shifted, or from investors from a risk-return perspective, and how do they, again, back to priorities. Obviously, we have seen a kind of some price volatility in the cat bond market, and obviously different dynamics in the reinsurance market and otherwise. But yes, also how do investors, what are their risk-return expectations, and really do they differentiate by product, or what is your experience, how they look at that?
Yeah, it has certainly shifted up, and we see two different kind of investors. We see investors who now say, well, I always only wanted to earn 5%, and now I'm going to buy a German government bond, and they leave the asset class. But we also see the opposite of investors saying, well, for cat bonds, it's an alternative investment for us. I'm expecting 10% plus. Well, now we are 10% plus, so they come into the asset class. And then we see everything in between the two. But I think what remains is what you point out, the relative value against other asset classes. And we always say, or we tend to say, cat bonds not so much correlate to financial markets, and it's not fully correct, because in the end it's a market. And we are in competition not so much against each other, we are in competition against high yield. We are in competition against CLOs. Because the investment that now could be made into a cat bond fund, if cat bond spreads were 200 basis points lower, maybe it would end up in a subordinated bond fund, or in an alternative credit fund. And I think that puts a natural limit to how low spreads can go. And again, here sustaining growth and returns, there is a link between the two. If we get too much in inflows, a lot of the money that now has entered the market will leave the market again, and that should then help spreads. The only question is, will it be done in an orderly manner, or will it be done in a rather uncontrolled fashion after a big event, for example?
Mike,
yeah, and I think for investors, this is really the first time you're earning a true collateral return on top of the spread. That's something really with zero rates for the most part since 08, 09, that investors, you can say, oh, there's two return components, but this other one, it's zero, so don't worry about that right now. Now you're getting that true boost for a cash plus type of investment, which some investors, they're looking for cash plus 4, cash plus 5, cash plus 6. Doesn't matter what the asset class is, as long as you can deliver that cash on a cash plus basis. So the current rate environment has definitely been friendly to this type of investment, particularly in the ILS space.
Yeah, well, I echo most of what you guys said, but I think if I have to add one, is that this year is setting a very, very high bar in terms of performance for the following years, which I'm trying, to kind of cool down the sentiment of my investors, saying it's not. I mean, this year if we have no events whatsoever, we may post like. I mean, I'm not saying myself, the whole cat bond market may post like almost like a 20% return for the end investors. Now, I think the challenge is to make sure that the end investors don't get used to it. I mean, I would love for them, right? But that would be a challenge. And to keep them still warm, right, about staying in the class, not just because one year you post 20%, but because you still have, the usual diversification, lack of correlation, and low volatility, component against other asset classes. I also think, though, and again, back to the relative value with other asset classes, that depending on how now situations in developed economies develop, so US and Europe, recession, soft landing, and the rate hiking cycles, we may have some shift to much more safe asset class like investment grade that may benefit a lot from like reduced rates volatility and perhaps central banks are deciding to cut rates. So again, we don't compete much, or not only against each other in terms of managers, but a lot we compete for cash, right? And cash can go into ILS, can go into IG, can go into high yield, in sub-funds. So I think that's another challenge to keep in mind when we pitch our investment to investors.
Maybe one follow-up question on that. Obviously, you and Florian, more European type kind of focus. How does the currency trends kind of figure into that? Obviously, the US dollar has strengthened a lot. Now is weakening again. Yeah, it would be interesting to maybe hear a little bit your thoughts.
Yeah. So most of our investors hedge currency risk, or we hedge it for them. So they buy currency hedge share classes, and there's two issues with that. One is understanding of hedging cost. People in the past looked at it and said, "Oh my God, it's 4%. I'm going to lose that money." When in truth, it was only the interest rate differential. So it still seems that it's a topic which is not as well understood as it should be. So that's on the education side of things to explain to people, well, no, it's not really a cost. It's the fair cost of interest rate differential. And the second implication, and that is a much more significant one, is interest rate hedging or FX hedging is performance neutral, but it is by no means liquidity neutral for the fund. And in our fund, for example, we have roughly 2/3 in non-US dollar hedged share classes, which means if the dollar goes up by 1%, we have a liquidity event of roughly 66 basis points. And for that, we need to hold liquidity in the fund. And that's also not something that is well understood. So I always tell investors, if you want to make my life much easier, buy the US dollar share class, because then my problem becomes their problem, and that clearly is, from fund perspective, preferable.
Does that limit growth in your perspective?
No, thus far it has no. It limits the investment degree in the fund, because we need to hold some cash at hand for these FX hedges.
Well, I face the same challenges. We got hedge class and non-hedge classes. We try to kind of guide the most conservative type of investor to the hedge share class. So euro is the base currency. We hedge dollar exposure, while some other more, say, opportunistic or tactic allocators, they go for the unhedged or the US dollar, and then they rather hedge themselves, the currency exposure. So basically, we allow them to make a call also on the currency. So if they are bullish on US dollar, they will go for the unhedged. So they make the return from the cat bonds and the appreciation of the US dollars. It really depends on what investors want and why they buy the cat bond funds for.
Okay. Yeah, I think we have around 10 minutes left or so, but kind of just maybe Hervé, from your perspective, also as we're looking kind of forward from an outlook perspective, I think would be interesting to talk a little bit about what everyone's outlook is and where they believe the market is moving to. Obviously, from a sponsor perspective, it specifically would be interesting to hear. Yeah, again, I think we talked a little bit about the different market segments, but more specifically, or what do you want to see from the ILS market over the next, let's call it 6 to 12 months? Is that more? Yeah, that would be helpful.
So I think the topic was sustainable growth. Yeah. So how are the current rate environments sustainable? And that would depend on the class of business. So I think it was Raphael this morning, he talked about the cat bond space where probably there's an imbalance. There's, at least as a sponsor, we see more supply, let's say, the growth in inflows of money is probably exceeds the new issuance and the increase in cat bond issuance, meaning the spreads will probably tighten further, although they are quite high level. When it comes to other asset class, so other classes of business, let's say in the private ILS property cat, we see really an opportunity to have sustainable high returns for the near 2-3 years. I think there's a clear shortage of capacity in the reinsurance market. There's a clear sentiment and a clear underwriting action by most reinsurers to improve the quality, which will reflect into the in the results at the end of the day. Now there are other areas in insurance and reinsurance that have had really sustainable rate increase over the last few years. I'm thinking here on the insurance side, the commercial property and energy. It's been the last 3-5 years, compounded returns, a compounded rate increase that are quite significant. And I think we talked about cyber. I mean, the lack of capacity will drive again rate. So these are the areas where I think if you want to grow and have more sustainable returns, I think these are the areas where there's both demand and also a prospect of higher returns for the next few years.
Mike, do you want to share your perspective?
I agree with a lot of the sentiment there. We're looking for hopefully new and different sponsors to come to the market, bringing deals, maybe diversify the sponsor base for specific perils. California earthquake, the CEA, huge participator in the cat bond market. Everyone tends to like the deals they bring, but it also just brings some concentration risk with the sponsor. So to see new and different sponsors within specific perils would definitely be a welcome change or adjustment for the next 6 to 12 months. And maybe outside of just specific perils, I think more sponsors accessing the cat bond market, it seems like that's where most of the capacity is right now. So in order to really broaden that breadth of issuers from both a type and a peril perspective would be great.
Well, not much to add. I think, for us, given that our fund is not huge yet, it's not a matter of having more sponsors as long as we can get the right price for the right bond. So, I'm happy with the current sponsor landscape, to be honest. And again, I think if we can provide the right return for the risk that we run, then that's good for us like that. I mean, it's your job, right, to get more sponsors to the table.
Yeah,
I didn't want to say that.
We're working hard on that. So,
yeah, well, I would love for Steve to update the ticker on his homepage to show 50 billion cat bond market at some point, and then maybe 60 or 70 billion. Because also a lot of the topics we discussed, transparency, liquidity in the secondary market, they go away if the market becomes bigger. And I think that's a push which is needed. Maybe some ambitious how that's done. I would say more straightforward modeling, modeled, updated more frequently, and maybe also deals with a bit of a longer maturity time. Because with a third of the market rolling off every year, we always have these 10, 50 billion of issues which need to happen every year. And if there's an accident down the road, if there's a big event, and we miss 1 year or half a year of issuance, the market starts shrinking again. So it would really help to lower that reinvestment risk and be in longer dated deals. And also, I keep telling sponsors, I'd be willing to actually get a lower rate of return, but lock it in for longer.
Especially now, right? In this environment.
Especially right now, I'd love to defend.
Well, I think that's
without call options.
Exactly. So I mean, maybe kind of two questions on that also. So one, I think it would be interesting to hear a little bit from a sponsor perspective if that's more attractive, less attractive, and then I think two, I think we had attempts with that to try to push maturity. I think feedback from some investors at least though is that the opposite, that similar to other longer dated securities, they attract higher spread, and then obviously the third element is the how do you deal with 3-point models and other things, and how do you control kind of stability within that. But I don't know if you want to share some thoughts.
No, I think we welcome more multi-year issuances and appetite for that. I think the 3-4 years is probably the good sweet spot, because if you extend over that, I think all the extension mechanism may be problematic, and also the need of the underlying book, because at the end we need to edge our own exposure, may have changed dramatically. So I think that's we're aligned there. I think there's but I don't see really 7 years cat bonds or the likes. It would be really hard to manage.
Mike, what's going on?
I think just from the longer dated deals, it's an alignment of incentives issue. Obviously, the sponsor in this rate environments, they're not going to want to lock in longer deals. Investors want longer deals, but when the rate environment's a bit lower, the sponsors will be like, sure, we'll give you your 7+ year deals, and the investors are like, I don't really feel the need to lock in for that long. Maybe rates will go up, and if they go down, I can just buy, maybe I'm giving up 25 basis points in 3 years versus potentially a hardening market post-event. So it's that push-pull dynamic of trying to align the sponsor and the end investor in the cat bond market.
So I think it's a supply and demand here as well, right? So I think back in 2017 there was Japanese sponsor trying to secure like a 7 or 8 year capacity. The bond failed at the issuance. when spreads were just at the tightest ever. Now, of course, you ask me, do I want like a 10 years deal at, I don't know, 15% spread? Of course I do, right? But the other side may not agree. So I think in the end, when you balance those two, forces, you end up with what we have now, so 3 to 5 years. If you issue something in a very high spread environment, you get a call option to protect the issuer. If they can reissue after 2 years, maybe at lower spread. So it's a wishful thinking. I don't think we're going to see longer dated deals, to be honest.
Sounds like I'm hearing heavily discounted spreads for longer term deals. So that's good. Perfect. Well, with that, I think we have 5 minutes left. I don't know if the audience has questions. I see one there.
I two questions,
if
I could.
I think you got a microphone.
Yeah, two questions. When we look at the asset class over, let's say, 15, 20 years, the asset class had an amazing growth. I mean, for all of us being in the industry for a long time, it's amazing to see the growth that has been in the asset class. Now, my question is the asset class now reaching some type of a structural limit? Walking in here this morning, I thought it would pick up more enthusiasm. You were the growth panel. I get out of this panel a bit depressed on what the growth could be. I don't know if everybody else picked up the same. So that was my first question, whether is it reaching that level? The second question I ask is maybe more for Michael, who has a different perspective because you're selecting managers. Do you think we're going to see some type of manager consolidation in this space?
Yeah.
Are there too many people managing ILS right now in terms of cost? Does that make any sense? And is cost maybe one of the limits? So those are my two.
Yeah, I think we've already started to see that consolidation over the last 4 to 5 years. There's been a lot of M&A activity within the ILS space on the manager side. Obviously this year, RenRe and Validus is the big deal, scheduled to close later this year. So in all likelihood, that's going to consolidate several fund options for allocators. But we've seen that just be a continuing trend. We've seen a lot of interest in maybe independent managers partnering with a reinsurance firm to get access to the rated balance sheet, so you're not having to pay any fronting fees to really enhance the capital efficiency there. So in short, yeah, we're seeing more consolidations. There aren't nearly as many truly independent ILS managers now than, say, 10, 15 years ago.
Yeah, and I think to your first question also, obviously we stand at 100 billion. A smaller portion of that is cat bonds out of a $500 billion market. So I think the two questions addressed here on one, growing the pie, and I think others should jump in. Or I think we certainly are strong believers that this market has a lot of run room. But I think it has to come from two elements. So one, growing the overall pie, and that's through parametric, cyber, other things. But then two, also to make the ILS product more user-friendly. I think we talked about things like aggregate and other things. I think there are definitely growing protection needs from this industry, which I think the capital markets can address. But from how big this market can go and what's the growth potential, I don't know if you guys have any other thoughts you want to share.
I'd say the growth potential really hinges on event activity, and people get frustrated year after year of events, hurricanes, severe storms, secondary perils. So if we can get through maybe a year or two of clean years, then there's likely to be a lot more interest in the space, understanding the uncorrelated nature, the diversification benefits relative to these traditional asset classes.
But isn't what the asset class is about?
Depends on the investor.
But can I add something? I think we have to wash away the picture of the guys investing in ILS and then spending 3-4 months during summertime with finger crossed that nothing happens, right? Because when someone buys like an equity fund or a bond fund, I don't think the guy is staying 365 days, in his room like this, saying, "Oh, hopefully nothing happens," right? I think we need to make a step in the sense that people have no problem investing in the equity and the credit of an insurance company. They buy Zurich, Allianz, Swiss Re, Munich Re. And they are not like, oh, let's hope that there are no hurricanes this season, right? They still buy the stocks and bonds without making all these concerns about how complex, arguably, or how obscure is the asset class. Well, I heard already 5-6 times today, and many times, people talking about this. This cross fingers picture is something that really concerns me, because if we keep going out and give the impression that this is an asset class where it's all about luck, not that no events have to happen to make a return, then we're not going to make it to the next 40 billion. We just need to market it as we are a different part of the insurance market. You buy the equity, you buy the credit, you can also buy the cat bond funds. It's not that we are anything meaningfully different than that, and that's what is required. We have to forget that we are a junior asset class. We are not anymore a junior asset class. We have what, 20, 25 years of history now, right? So there are other asset classes much more junior, which appear much more appealing to the people, like crypto, for instance, right? So we need to be able to make this step in the minds of investors. We are a branch of the insurance market, a branch of the insurance, of the investments that you can do in the insurance industry. And I think that would help.
Well, and important to one, I mean, we talked about this before, it's about risk-adjusted returns and meaning returns lie on a distribution, and again, model robustness and otherwise flows into that. And I think the other point to make is obviously given the yield environment we are in today from a return perspective, I think even with increased event activity, I think the fingers crossed approach should not be necessary to generate the return. Obviously, at a certain level.
It should at least be the core of an investment process to cross your fingers.
Exactly.
I mean, I'd be skeptical. But to go back to the question, I see no reason why the capital market couldn't be at some point 60, 70, 80, maybe even 100 billion. Because one thing is clear, there is more need for protection across the globe. I mean, there's tons of emerging markets out there which are not covered. They require protection at some point against climate risk. Yeah. And the capital market would be the perfect market to place that risk, as long as returns are okay. Nobody expects to be loss-free forever, but it should be reasonable. Losses should come from where people expect losses, not from things they didn't even know they are covered. And if the market does its homework on being a bit more transparent and maybe a bit more robust in the way things are structured and things are done, also process-wise, then I think there's a good chance that Steve will actually be able to put 100 billion in his ticket before we all retire. Yeah.
So if I may just add one point, I'm a true believer that if growth happens beyond organic growth, it's going to be outside property cat. But now matching investor appetite versus the demand from the insurance industry is really the challenge. But that's the only real avenue to get really a boost in the ILS market. I truly believe that.
Any other questions? I think we're going for lunch, Steve says. Well, thanks everyone for making the time. And,